is a weird relationship to sort of break.
Sam, what do you think about this whole Amazon thing?
Dude, I was trying to set up my Bluetooth for a little bit, but I couldn't get it done. What's going on, guys? Hello? Hello, Tevis.
Good.
Hello, Roy.
Glad you're here, man. I like the name change on YouTube.
Actually, that was always the name. I just switched to the channel that I always stream off of versus my kid's account.
Very good. Very good.
I don't even know like where were we on, because I missed like the last few minutes.
Just what I sold SOFI for Amazon. Did you hear that piece?
No, I did not.
No.
I mean, it's probably in the short term. I mean, who knows where these small caps go up and down. Probably less risk for Amazon in the short term. I mean, long term, you probably have a much higher trajectory for Amazon. I mean, but who really knows? I mean, obviously they're cutting rates. I feel like the market already priced it in. We got like a 95% chance of getting a rate cut for the next meeting. And I think it's like around 90%, 92% for 2 rate cuts in the meeting after that. So far, the Fed is projecting around like 3% by the end of 2026. So like we're kind of seeing the end of the rate cut cycle around like 2.8 to 3%. So then that would be like another 2 more rate cuts by the end of 2026. And when you really think about it, I'd be like,
can I share my screen on that?
Yeah, go for it.
So this is call sheet. This is the number of rate cuts. And like you can see the 3 rate cuts option has skyrocketed over the past couple of days. Any thoughts on that, Sam?
I mean, this is more of a betting market. I look at more of the CME Fed Funds futures. So that is going to correlate very highly with this. This is a betting market. Obviously, the market makers in this are going to want to be lopsided more toward whatever the CME Fed Fund futures are pricing in, which is more of like where the big money's at. But I don't know. I mean, like 11%, 85% chance of 3 rate cuts, a 6%. Yeah, that actually falls in line with it. Pretty much what I'm saying. I mean, SOFI as well as other small caps are really going to move. And this also goes with Klarna as well. I'm also a shareholder of Klarna, that these companies make more money on that delta between what they can borrow against and then what they can loan against, right? So this is how banks work. This is how Nubank works. This is how a lot of these companies work. They want lower rate cuts. Obviously, Nubank is a bit different because it's more ex-US. But, I mean, SOFI obviously has a much longer trajectory than Amazon. You know, how much can you possibly grow a $2.5 trillion company that's growing at about 11% year over year? But to touch actually on what Steve said earlier when it comes to Amazon, the bull case in Amazon is not growing margins in the e-commerce segment. The bull case is growing margins on AWS, but also scaling AWS out. So if you have Amazon growing or AWS growing at 17% year over year as of last quarter, at about like 34-35% operating margins, which is going to contract a little bit as they continue to increase CapEx. And that accelerates to what SemiAnalysis and other analyst forecasts is around like 20% plus for 2026. Then you're talking about increasing the operating income for a company. And not just any company, $116 billion company as of last quarter. Like, that's a lot of freaking money. And the market loves to front run all of this stuff, right? So right now, Amazon is trading. It's one of the cheapest med caps as well on a forward price to earnings basis. I don't know if that's really going to change. Like the stock price goes up, that's definitely going to come up more as the price of the actual market cap increases. But the margin expansion story is much more important. Right now, you have basically e-commerce at about like $500 billion plus. They continue to accelerate their investments in emerging markets. Their whole robotics thing, I don't know if that's really going to come to fruition until like 3 years from now, at least, right? Like they're all talking about expanding robotics and everything. So it's much more of a hype scenario than anything right now. But to actually see like a monumental effect of it, because we have at least 3 years out for that one. But the play right now is the data center catch up. They have been contracting growth for the last couple of quarters, with Amazon going from 19, 18, and 17% last quarter for AWS alone. If they expand that one, and we already have the advertising sector already growing at 19%, which is already high margin business. albeit it's not the biggest business they have, but it is high margin. If that continues to accelerate, that's going to like flip the whole sentiment in the stock, right? So like what was once like, okay, we have all these tariffs and everything around, Amazon's going to be hit because it's consumer and all their margins, everything. It's like that's going to change. That's going to change overnight if they show growth in the AWS sector, because with Azure and GCP accelerate and Amazon didn't. That was like the underlying fear last time. I really feel like that's the all telling sign. If they're not above 18% next quarter, the stock is not really going to go anywhere. If they're at 17% or slower, then it's going to go down. Yeah. For sure, it's going to go down.
For me, I'm willing to take that risk of is it going to accelerate when you see the operating margins really start to show up with automation and really the operating margins in Europe, I think, start to show up, because right now they over the past several quarters, I haven't checked last quarter and I need to review myself, but last quarter I felt like they were either just slightly break even or even maybe slightly negative, but they're not nearly as profitable on the e-commerce side in Europe as they are in America. So I'm curious, as that kind of builds out in the rest of, say, the international markets, how that brings up the rest of their operating margins, and then you include the automation piece from it, or innovation piece, from what I'm hearing, how that actually impacts the bottom line.
I mean, go ahead. Sorry.
I was going to say really quickly on the European side, the Amazon might actually grow a little bit faster than on the US side as far as e-commerce over the near term. The big hit is the de minimis actually ending for tariffs. And so that's a hang over Amazon. Of course, it impacts Temu and others as well. So it's not just isolated to Amazon, but that's not in Europe. And so that might actually surprise people on the European side. And hopefully it's factored into the sales price on the U.S. commercial side. But that ended in September for everybody. It was impacting the U.S.-China corridor earlier.
What do you guys make of Jassy? Like, that's the thing that I'm interested in. Like, Roy and I have had this conversation a number of times in terms of just his stewardship of Amazon and the appreciation that he's seen through.
Bezos needs to get off his yacht and get back to work.
That's what I think too.
Jassy was the one who brought AWS to Bezos. Like, I don't think there's anything wrong with him being a CEO. If you ask me, I think Bezos is still piloting ship. Like, in the last major interview we had with I forgot, Andrew Sorkin, it was basically that he works at Amazon still. Like, he has not stopped working at Amazon. He's still running the ship. Like, there's no way all this is happening, but it's like, yeah, it's cool, you got it, right? And plus, I would not be an investor in Amazon if it wasn't for AWS. And Andy Jassy was one that originally pitched that to Jeff Bezos. So I have every confidence that Jeff Bezos is going to do just fine at Amazon as the lead or CEO of Amazon. And then also on top of that, Matt Garman, who's the CEO of AWS, he's been there since pretty much the beginning. And he's been the head of EC2. EC2 is basically the VMs that run in Amazon. And that was like its cream of its crop when they first started. Obviously, we've shifted left in terms of all the infrastructure over the last like 10 years, where it's becoming more of a serverless infrastructure. But Garmin has been there the whole time. So he knows how to run this company, in my opinion. The previous CEO, can't really speak too much about him. I think he got kind of like more pushed out than anything. But Garmin's been around there for a while. So you have Jassy, who's from AWS, or he is basically one who brought AWS. And you have Matt Garman, who's running the 35% operating margin business that's growing at 17% year over year. I don't know, like that's probably the best people I could think of. Maybe it's like more of like people attach like the stock price to who's running the ship, so it's like that's person to blame. Because I remember everyone was blaming Sundar Pichai. What, like 6 months ago, they were like saying he's got to go, but like where's all those arguments now that Google's at an all-time high today? Like, those arguments are just gone, right? So, like, you tell me. I mean, when Amazon hits new all-time highs, which it probably will in the next year at least, are people going to complain about Andy Jassy? I don't know.
I don't think they will. And I think one last thing that I'll say before we potentially move it on, because we have talked a good about this segment. I'm curious to hear if anybody else has any other thoughts they want to bring into the room. One thing that I look at specifically is the operating cash flow more so than the net income. For people that are understanding how Amazon is different than maybe some of the other Magnificent Seven, the amount of depreciation, because you have warehouses, you have trucks, you have all this infrastructure that you need to invest in from a capital expenditure perspective that you're depreciating every single quarter. I look at the ops cash that's coming in. So when you think about the actual cash that's actually hitting the balance sheet, $121 billion coming in specifically in the trailing 12 months, meaning basically from Q3 of 24 to Q2 of 25, $121 billion. And they invested over $100 billion in the last 12 months. I mean, that's insane. And if you compare to what that actually means when you look at the net income, I think only shows 70 billion in the trailing 12 months. So when people are saying, oh, the price to earnings is X versus Y, it's like, actually the price to earnings is, when you think about the actual operating profit and the cash that's coming in, this net income is impacted extremely immensely, I should rather say, by the depreciation of all the benefits associated with all the real estate that they own and the trucks, etc., artificially pushing this down so they have to pay less in taxes. So I like to look at it more so from an ops cash perspective. And if you think about this, Amazon's only a $2.3 trillion company. You say only, but they have $120 billion in ops cash. That's a 20x in terms of multiple. To me, that seems a lot cheaper than if you're talking about 2.2 over 70 billion, right? That to me is the real number that you want to look at. And I think when people see this number of 70 billion, they think that, oh, no wonder why it's trading at a discount to Google. But in reality, I think this should be trading closer to $3 billion stock as it is today, with just what we have in terms of ops cash. And I think that ops cash, as you saw in the trailing 12 months, is growing like gangbusters. I mean, just in the last year over year, it grew over 15%. And so I don't think that you're going to see that slow down. And if you think about that in that perspective, they're able to grow that 10 to 15% a year. They're going to be able to grow that by an additional $200 billion a year, very easily. At no problem, and that's without any ops efficiency gains. Then you have some ops efficiency gains, and it'll be even better than that.
Matt, bring up my screen. So these are the big four cloud players, and we know Amazon's margins are not great. They're trading at a pretty attractive valuation for a company that can completely expand operating margin without adding revenue. And I'm not saying they're not going to add revenue. What I'm saying is they can completely overhaul their internal business through robotics and AI over the next 3 to 5 years, in addition to gaining in AWS, in e-commerce, and moving into big box, going after Costco, and building out their advertising platform, which they've barely tried, and they're already number 3 in the world. So this is a company that can add a lot more earnings growth as margins expand. And as margins expand and revenue grows, they add a lot more profitability to the bottom line. This is going to look even cheaper if that happens. Keep in mind, 11.8% operating margin on the total business. They have 160 billion to 170 billion of general administrative expenses. That's a lot of freaking money that they can drop right to the bottom line through optimizing the business. I mean, to me, this is a no-brainer.
Yeah, I mean, I've looked at the comparisons, and I'm a shareholder of Meta, shareholder of Amazon. More little leverage on Amazon than any of them. Wish I held Google. You know, I'll be the first to publicly admit that I sold Google probably at the worst possible time ever, but that's fine. But you know, I agree with you. I mean, like, even though AWS is not as large as the e-commerce business, it is very high margin. So if that's accelerating next quarter versus like around the 10% for the e-commerce business, then you're talking about adding more margin expansion to its operating income. Right. I mean, that's really what it is, right? So they're going to be increasing their capex, like without a doubt. Largest hyperscaler in the world, they're going to increase their capex, and so every single other hyperscaler in the world. So you have Azure, you have Google, and then Oracle. Like I don't even know like what Oracle's raising like $38 billion. Like they're just running on debt at this point. Oracle is probably the one that I don't want to own right now because they're fun. If you think of like one of those companies that definitely cannot sustain their operating expenses from a profitability standpoint, it is definitely Oracle. Like that's probably the one that I'm the scariest to be in. The scariest to be in, probably the most upside, but the scariest to be in terms of this leverage data center theme that we're in right now. But probably the safest one when you think of the bang for the buck you get as far as the cloud business alone, right? So Google's cloud business is like 10% of its revenue. Azure is probably like around 20%. Amazon is probably like around 20 to 30% of it. But like that's the only reason why I'm invested in this company. Like I would not invest in Amazon if there was no AWS. I would put the money in Mercado Libre, without a doubt. Like Mercado Libre is the one that's growing and probably has a longer trajectory than the AWS e-commerce alone, because AWS is already, Amazon e-commerce is already established. Like what else can you possibly do with that? The momentum with Amazon is ads with Prime Video, also with expanding and with their partnerships with other companies as well, but also with AWS. Like that is the only reason why I'm in Amazon right now. E-commerce, maybe, but there are so many other better plays if I'm really striking e-commerce. So it would be C Limited, it would be Grab, or adding more Grab, even though that's not necessarily an e-commerce play. It is considered of the smartphone penetration to other countries besides the US. Mercado Libre, of course, and then there's other companies as well to be involved in that one. There's actually no, you know what? There's one that Samuel Mercier was talking about in Europe, but at the same time, like emerging markets is the way to go whenever it comes to e-commerce, not necessarily US. Amazon is just AWS strictly and ads.
Interesting. All right. Well, Amazon, I'm buying it. There you go.
So
I'm the only bigger position than I do, dude. If you have 1,000 shares of Amazon, you have more than I do. I'm not at a pool. I'm actually at a brewery.
You own it, Sam?
No, I do. I own Amazon, but I think Matt has probably a much bigger portfolio than I do. Like I'm not like a swimming millionaire like a lot of you guys are. Just the average Joe over here.
You have a lot of positions, don't you? Though you're more diversified.
I've dramatically reduced it as of recently. Like I had EOS, I sold that. I sold Navitas. I've really trimmed my positions down to focus more on like more of the value plays than anything, but also being part of the theme. But I would say a large concentration of my portfolio is either Amazon, Mercado Libre. Now it's Toast as well, Lemonade, and Nebius, of course, and also Iron. I want to grow it, but like that, I cannot catch that thing. I literally cannot.
Yeah. Yeah. I guess I'm the only one that doesn't own Amazon here. It's always been one of those that, like you said, Matt, earlier with SoFi, if you had 25 or 30 companies, SoFi would be there. I'm like that with Amazon, but I own 10. So
yeah. No,
there's an opportunity cost. There's an opportunity cost with that, right? Like Amazon's not going to 2x, right? But like you can pick one of these other companies. They're probably going to 2x if you stay in a bull market, you know. But when you think about the amount of risk, like a lot of these companies, you see macro fall off a cliff last Friday and the Friday before that. These other companies are going down like 10, 20%, right? But Amazon is going to go down 20%. It's going to go down 5%, which is still a lot for a $2.5 trillion company. But that's the reason why I diversify, is because it's very hard for me to stomach this kind of volatility, especially like when I'm at a much different age level and risk tolerance than a lot of other people out there.
Mm-hmm. So, Steve, we were chatting about things that we bought. Not sure if you chimed in today with what you had bought. I know we talked about it a little bit yesterday, I believe. Was it yesterday I was on stream with you? I'm trying to remember.
May have been the day before.
Yeah.
Yep.
What'd you buy?
Energy transfer, baby. Energy transfer. Getting paid almost 8% on the distribution. It's undervalued. We need a lot more natural gas. There's only certain pipeline companies that can move it. As the largest pipeline network across the country. And I think it's an undervalued gem. I love the distribution. It's part of my income producing portfolio. I bought some more CTO Realty Group. It's a REIT in the Southeast and Southwest. It's a smaller REIT that is trading under book value, and it's paying about 9.5%. And I bought a few other things also.
Yeah, I saw, at least you're on the stream with Amit yesterday. You talked about Schlumberger and Halliburton. Did you actually dip your toes yet, or are those just thoughts?
I'm a Schlumberger shareholder. I have not bought more in maybe a month or so, maybe a month and a half, but I am planning on increasing the position on them. I think the drillers and the wells, I mean, they do so much. I mean, you know way more than me about them. They do so much on an international level. And when you think about where the energy is coming from, we need more of everything from renewables to traditional resources. And the upstream producers are just going to produce more. You look at the trend for oil rigs, you look at the trend of production by company. Schlumberger is one of those companies that trades at like 13 times this year's earnings. Buyback plan, dividend plan, getting paid over 3% on the dividends. I like it. I actually bought some more Verizon this week also. I think Verizon, I mean, at 38.5, 7% dividend, give me that all day.
So
Verizon, Jesus.
Yeah, well, it's 7% dividend yield if you believe in the company and you don't hate Dan Schulman. I think he'll be okay for the first few years, but man, I would not want to own this company long term with him there. I think he'll do what he did at PayPal, where he just falls asleep at the wheel, and then the company runs aground, and somebody else has to come in and try to resuscitate it.
You realize
he was terrible. He was so bad.
Billion in EBITDA, right?
What's that?
You realize they do $49 billion of EBITDA, and nobody's getting rid of cell phones.
Yeah, but it's commoditized. So like the growth there is limited. The dividend I think is intact. I don't think it'll be terrible. I just the yield, like if you're doing it for the dividend,
not a growth play. I don't think Verizon's getting past 50. That's not why I'm in it. I think it's going back to 45 and it's paying. And I'm locking in a 7% yield on cost.
Maybe, yeah. Schulman did a good job when he initially came into PayPal to do some things. Of course, he was instrumental in branching out from eBay and being its own publicly traded entity. Braintree and Venmo buyouts or purchases, acquisitions. But man, there were just no concrete vision. He doesn't know how to lead a company like this, but he does know how to get the market excited for a little while. So you may be right. If it pops to 40. Steve, you might want to look for the exit.
No way. I've been in Verizon for a long time. It's this generation's utility company. Utilities are paying 3%. Verizon's paying 6.5 to 7%, depending on where it is. It's one of those things where I'll hold it for 10 or 20 years. I could care less. It's not something that I need to sell to get money out of. It just needs to keep paying me. Let me plow the money back into it and keep generating a larger dividend.
Yeah, Schulman's going to screw it up. It'll take a few years, but he absolutely will.
Look, if he screws it up, he screws it up. I have my other dividend companies too. It's part of a very diversified dividend portfolio.
Yeah. So the yield is basically you're capitalizing on the fact that the stock is down to get a higher dividend yield, and that's why you're buying it?
Yeah, 21 years of consecutive dividend growth. They have $8 billion in retained cash flow, I believe, after they pay the dividend out. They are repaying more debt than they are issuing, and they're growing their EBITDA. And I don't see the debt load as a problem because they have a lot of it at low rates. And the high rate debt, they'll be able to issue new debt at lower levels next year and add more margin. So it's not something I'm worried about.
But why wouldn't you just buy JetQ? You get more diversification and higher yield for lower.
I own JetQ.
No, I know, but why would you?
What do you want to talk about? You want to talk about JetQ, JEPI? You want to talk about SPY?
No, I'm just trying to understand.
I own all of them.
Okay, with the money that you put into Verizon, why are you okay to get a lower return on that money relative to something like JetQ?
Because that's not something where I'm looking at total return. I'm looking at a diversified stream of income because JEPQ is not a fixed monthly distribution. It varies.
JetQ, it's a call option strategy. Like
Yeah. So
Verizon's not
JEPQ,
selling calls against their own company. Like that's very different. Also, you got to think risk tolerance here, right? Like, so Steve is not going to go out and buy Nebius like 10% and sell puts on it. I'm not saying there's anything wrong with that. I'm just saying like these are two completely different risk tolerance factors. Completely different.
JEPQ, I actually am not liking their strategy anymore, and I've been considering exiting the position, adding more to QQQI, because what the JP Morgan Asset Management Company is doing is they're running 80% of their strategy in equities and 20% in exchange-linked notes, and they're running the cover call strategy through the ELNs. And the NEOS investment group is doing call spreads, which allows you to participate in the upside when you're in a bull trend. They've actually outperformed JEPI and JEPQ, SPYI and QQQI. And I don't want all cover call funds. Like I want traditional equities in there as a balance. And also I know what I'm getting the growth. These funds can fluctuate. And if you get less volatility in the market and it's stagnant or even a declining, you're generating less income in the future.
And you're not scared that it's going to be a value trap because they're not really growing.
Yeah, but it's not on my capital appreciation side of my portfolio, so I don't care. Verizon could stay at 40 for 10 years. I don't care. I'm collecting the dividend and plowing it back in and generating more income.
Yeah, and like what you're saying there, I think is fine and fair. Like if you're just buying it for a dividend, I don't think they're a dividend king. Schulman's not going to change that. That's not going to go away. What he's going to fail to do is actually help Verizon grow as a business. He's going to fail to help them pivot into the age of AI. He is going to expand, probably, if anything, the workforce rather than reduce it. He's very woke as well, so don't be surprised that there will be some headwinds that come out in a few years just because of some of the policies that he'll implement. He's done it before. He will do it again. He's the same guy. But since you were just like looking at this as like, hey, I'm fine with it trading in this range and taking that 7% yield, and that's not a bad play at all. It's not where I would want to be personally.
Yeah, I mean, look, it's not for everybody. I have a lot of companies nobody on this stream would buy. Like, I don't think anybody would buy Altria Group. No. Maybe Matt would, but I mean, I don't think the three of you would. I don't think you guys would be buying British American Tobacco or AT&T. I own all those.
Salesforce too. I think we're
Salesforce is very undervalued. We can get into that. We can go down that rabbit hole if you want.
You should buy ServiceNow instead of Salesforce.
Yes, I like that.
I think a lot of people would like that.
Matt, just speaking of just before Verizon, we talked a little bit about LNG. Curious to get your thoughts on Next here because it's gotten fairly cheap. I mean, I remember it was over 10 a couple months ago, and now it's under 6.
Mm-hmm.
I've been buying.
Can you talk about Next?
No, I can talk about Next. I can talk about VG. I just can't talk about specific parts of VG.
All right, let's go. Let's go.
But yeah, Next Decade, I think what it is right now is that you have a lot of institutional. What's that?
Throw up the chart if you can.
Yeah. I was going to bring up, so the reason why I had Comcast up is that Chris Patel and I were talking about Comcast that has trading less than a 5 PE. So before I move on to Next, it was interesting. It's a $100 billion market cap, 100 billion or so in debt, but makes about 16 or so billion dollars in net income. So we're kind of scratching our heads as to why it's so hit so much. But I think that they're trying to spin off, I think, one of their businesses, and then obviously debt load being a big piece as to why it's being impacted right now. But we thought it was rather interesting. But yeah, this is the 6-month chart for Next Decade. So Tevis is right. It was peaking out at over $10, $11. And I think that a lot of that was in anticipation of train 4 and 5 getting sanctioned towards the end of the year. And I think when the assumptions came out for trains 4 and 5 and the cash flow expected to coming out from trains 4 and 5, when they came out at a $5 assumption, I think that what the banks were really forecasting was something north of that, closer to $7. And so that means for the spot pricing, and so for people that kind of understanding, it's not an exactly analogous specific to pipelines, but there's basically fixed contracts for a lot of these trains that show up. So the first 3 trains, they have about 92% of the volume contracted. So pretty much what you see is what you get. And then there's 8% of the volume that's uncontracted that they sell at spot prices. And those spot prices, they were assuming, some of these banks, or one of the major shareholders was assuming it's $7. Well, now that Next Decade is assuming trains 4 and 5 at $5. Now it's assumption. You don't necessarily know until you actually sell those things. They were saying, oh, well, the cash flow is not as great as expected. Well, my assumption for Next Decade, to be fully transparent, was, one, I was always holding it until mid 2030s. So to me, I think short term, I was never really concerned with the $6 range. And actually, I'm only down 5% of my overall position because I've been buying, at cheap prices, and I only bought a little bit in the $10 range and above on my normal increase in cost basis. So there's that. But then 2, where was I going with that? I was always anticipating that there would be a large amount of share dilution associated with Next Decade. And so what I was buying this company, I was expecting there to be, in order to fund trains 4 and 5, say, hey, we need $500 million or $1 billion in cash. We're a $2 billion market cap company. Let's sell half of our shares on the open market and get $500 million in cash to fund these two trains, right? Well, they did not do that. They were able to figure out a way and maneuver a way to keep 100% of the shares as expected. Yes, there is some dilution, but not nearly to the extent, not the 50 to 100% share dilution that I was expecting. But that being said, that impacts cash flow slightly. So on a project level, so if you think about it, the project level is going to be what it's going to be. And so what ends up happening is the net income to Next Decade ends up being, you have to think, the net income to Next Decade, you think about it, per share ends up being preserved because you're not diluting shareholders 50 to 100% per share. But on a project level basis, it goes down by $100 to $200 million. And so overall, if you look at it on a project level basis, it doesn't look good. But the fact that you're only sacrificing 10 to 20% of your cash flow and not diluting shareholders by 50 to 100%, which is what I was expecting, is a positive. So to me, I actually think that this is a huge win and actually better for the long-term opportunity, for me at least. You guys need to do your own thoughts as to whether or not you think it's beneficial. But I was expecting much more dilution, which when I was looking at the company, I was thinking it's going to be a $20, $25 billion market cap organization, but you're going to have twice as many shares. So you're going to go a 10x, but divide it by 2 because you're going to have double the share count. So you're only going to have a 5x. I think now you might be looking still at a 8 to 10x because of the fact that you're not getting that share cut in half. Now, of course, there's a lot of still other things that need to happen for it to get to that $20 billion market cap, but still very bullish overall. But that's the main reason for the tanking of the stock, is assumptions that people had. And I think JP Morgan came out today, or somebody else, Bank of America came out today with a $3 price assumption for the margins that they were get for spot pricing. And that's just absurd. In my opinion, that means that you're going to either have Henry Hub trading at north of $8 and MCF for the long term, and or Japanese or European markets trading at $8. So one of the two, and I don't foresee either of that happening in the next 10 years.
Why do the spot prices vary so wildly, Matt? From 3 to 7, like that's a massive spread. The assumptions, I mean.
Roy, what are you bringing up?
Maybe answer Tevis's question along with this, but I don't know this company at all. I know that this was tariff related, and you talked about this 50% decrease basically in the last 3 months. But it seems to happen about the same time, at least the last couple of years. Is there a seasonal aspect to this business, and that's what we're seeing there?
Regulatory. So it's regulatory. So it's zero revenue right now.
Yeah.
So last year, what the reason for that precipitous drop was the fact that the Biden administration, or the Department of Energy, really was putting their based off of what was an environmental study. They basically said, oh, they haven't done enough work, right? And so they put pretty much the license at pause. Well, they went through the courts, and later that year, which is when you saw the run up to $10, they basically said, yep, you guys are good. Everything was fine. They submitted all the supplemental information that they needed. They did the supplemental environmental study, and everything was fine. But basically they said it's like, you didn't have enough of town halls for people to claim, oh, this is going to ruin the duck feeding on my land, and this, that, and the other, and emissions, etc. And so I guess that was the complaint. And so they went to trial and basically said that was BS, and they did everything that they should have. But yeah, most of the time it's regulatory, and because it's zero revenue, any sort of news event like this cause a massive swing, because you don't have any fundamental revenue or anything to kind of fall back on.
Right. Okay, thank you.
Yeah, Tevis, you asked something. Oh, the spreads. So you have to think there's a lot of cost associated with this. So you could do multiple things. You can actually own the LNG facility, like NextDecade itself, or you can just specifically own the boats that take the LNG specifically from the Gulf Coast to wherever you're, say, regasifying it to. So in the case of most places, it's TTF in Europe, the title transfer facility in Europe, or in Japan. But you have to think it costs money to kind of get it there. So what you're doing is you're paying, let's say, you're paying to get it on the boat. So at $3 Henry Hub, you have to pay somebody $2.50 plus a little bit of premium to put it on the boat itself. So you might be buying it at $3.50 plus $3 to kind of get it on, plus shipping fees. You're now looking at pretty much all in costs at $7. And then you have to ship it all the way 2 weeks, 3 weeks time to go to Europe or Japan, depending on where you're going. And so that's where you're getting, and you're selling it potentially for $12, $13, $14. That's your spread. And so you might say, oh, well, the spread is from $3 MCF at Henry Hub to, say, 13, so that's $10 spread. But you have to keep in mind the fixed fees that you have to pay for the liquefaction costs. And so some companies specifically only want to focus on the shipping piece, so getting it on the boat and then worrying about that 2-week journey. Other companies like that fixed fee piece of it, because they could say, hey, I know it's only 10% or 11 or 12% rate of return, but it's a long cash flow and I can guarantee that. And especially if I can figure out the financing piece, I can get that, annualized return, and, over time, I can pay it back over a certain amount of time, refinance, extend it, debottleneck, etc., and maybe get that return on invested capital up to closer to 20%, etc. Some people like to do both. Venture Global likes to focus on both with the actual facility as well as the train. And some companies actually like to do all three, which is owning the upstream assets, the actual gas wells that produce it. So basically figuring out a way to develop it for as cheap as possible, get the gas out of the ground, say in the Haynesville, the Permian, the Eagle Ford, then own the actual facility that exports it, put it on the boat, and then actually get it to wherever it needs to. And then some of them actually like to own the regasification plants themselves. Each one of those places has its own margin associated with it, right? And value chain associated with it. So I like the fact that it's very stable. There's a lot of good success that we have here in the United States with LNG so far. And what I've seen I shouldn't go too much detail with this, but what I will say is I do a lot of studying of where gas is being developed around the world. And what I am seeing is with people truly lining up with the Paris Agreement and regulatory environments in certain countries, you're not getting nearly the energy supply that you should out of most places. And then that requires you to say import for most of your energy needs. So you have places like India, Japan, Korea, most of Europe, all in drastic need for imports, and especially going to the 2030s and beyond. And you have people that have been predominantly dominant in providing gas supply, specifically India having good gas supply right now, but going into the 2030s, unless they find more gas, maybe not so much supply going forward, and demand continuing to increase. But Australia has really good supply right now, but without further exploration will really drop off into the 2030s. So very bullish, specifically on natural gas in the United States.
That's
I think a lot of people. Oh, go ahead.
I was going to just say, interested in energy definitely next year. A lot of demand. Some energy plays have ran incredibly high, and others seem like left for dead. I think we just need energy. So I appreciate that, Matt. That's I have to go back and rewatch and do some research here, but that's all the time I had today, guys. So I just wanted to say, talk to you later, and we'll see you guys around. Thanks for having me on.
Yeah, much appreciated.
What's that?
You coming off tonight?
Yeah. Oh, yeah. For anybody that's a SOFI investor, Steve, Tevis, Tanner, and I, maybe Chris as well, will be doing earnings preview at 10 o'clock Eastern time. So join us.
I think Chris is at a wedding right now. He might not be able to join. We'll see. I'll tune in and watch you guys later.
You're leaving, Sam?
No. I'm just saying I'll watch you guys later. I'm going to be busy tonight, but I always got the earpiece in, listening to you rascals all over here.
Matt, let me ask you something. What next? How are they getting the LNG?
Pardon?
How are they getting the LNG?
Actually, Enbridge. Sorry, go ahead.
No, Steve, I think your input has switched to maybe a laptop or something.
Oh, my mic was not in front of me. Sorry. Good call. So, Matt, I just want to hear one word.
Were you fapping
the LNG?
Were you fapping, Steve? Is that why you had to move it?
No, I was typing. That's why I was on mute.
Enbridge.
Pipelines.
Enbridge.
But yes, Enbridge. What a great company Enbridge is.
Enbridge does a good job.
They're a triple threat. They're the only pipeline company that owns utility companies. It's amazing. And the North Carolina utility company that they purchased from Dominion is right up against freaking Washington, D.C.
That's why they pay the big bucks, Stephen.
I'm just saying. There's plays out there.
Sam, you're not much into you're mostly tech, aren't you? You don't really focus on the infrastructure stuff.
Actually, I'm very bullish energy. I think a lot of the market is really ran with like the speculative nuclear companies. There's probably like 2 nuclear companies that I would be fine investing in for long term. That's CCJ or Cameco, as well as CEG, Constellation Energy Group, because they're actually getting revenues from this. Also, there's Citron. There's I forget the name of the company. LEU is the ticker. I know I have a couple people who are bullish on that one, but OKLO and all that, like, it's just, they're just running with momentum at this point. I think these companies, like, they don't have any revenue. They're based on revenue they're gonna get. It was probably a good buy at some point, but now that's all been priced in, and the assumption is there, right? So like they either show up or they don't, or the market runs with high momentum, high beta plays, and they keep running. But at that point, I think it's like more of a trade or a gamble. But for long term, I think the play really right now is LNG. Like what I don't understand is like the market's running so hard with nuclear, but they forget like it's not a sustainable energy provider to be in nuclear right now. Like right now, right? If you think of the the more carbon neutral you can get right now in terms of the cost of actually utilizing it is really liquefied natural gas. Obviously there's oil, but that's not really favorable for a lot of companies right now because the price of oil is so low. However, when you think about like what's available right now, what do we have a lot of in the U.S. and also what's mispriced? I think that I've had Next before. I was buying it actually a little bit higher from here, and I trimmed some when it was like around $10, and then VG the same thing around 15, and I'm buying it again. Like this is just mispricing in the market, and they're seeing the news that's recently out right now in the market tends to be they tend to be forward looking, like very short degree forward looking, like maximum 6 months, and they take account of like what they're actually seeing. And right now the market hates these stocks, right? They hate Next, they hate VG, but there will be a time again where they come back. And in my opinion, I think the floor is not really that far from here at all. But when you look at these other stocks like OKLO or something, like this can go down a lot, right? Because they don't have any recurring revenue right now whatsoever. Like OKLO can go down to $20 and nothing's changed other than macro market, right? So like that's the scary stuff with these stocks. Like liquefied natural gas has been around for a while. We're the number one exporter in it. Like where is it going to go? Like this business is going to be sustainable. They've been around for a long time. So but Next as well. Like they're going to build these other trains, right? So it's like, has anything changed? Not really. Sentiment probably has changed the most, and that really is what moves stock prices.
Interesting. Steve, you noted that, well, first and foremost, Tevis, did I answer your question? I want to make sure I didn't dance around it.
No, I think it was a good answer.
Okay, thank you. Yeah, Steve's audience didn't like it. They said it was too long, but they can eat a dick. No, I'm just kidding. But Steve, I'm curious, did you ever end up buying any Next, or did you end up No, because you hate me, or just because you haven't done enough due diligence?
I haven't had time to really. I've looked into it. I like what I'm seeing. I haven't had the time to really get down and dirty with it. So I need to do more on it.
It's fine. No, I just think that it's something that you would. It's tough, right? And I think Sam is 100% right? You have to analyze, and I get this question a lot, right? Specifically about this. We don't have to talk about it. We can move on. But I'm going to make the statement of people always ask me, like, Matt, VG or Next? Actually, here, with the certainty that you can get from VG having actual revenue coming through right now and the cheapness of the stock, maybe I should pull it up at this point. But the stock has taken a big dump because of the arbitration, which I can't talk much about. But the piece about it here, it dropped, as you can see, very extensively from like $13, $14. I actually took some profits here in I believe it was the June-July timeframe and moved it over to next decade because I had bought before it went on its run at the $8 or $9 range and took like a 50% rise in a lot of my shares. And I said, well, if I'm going to be betting on something in LNG, I'd rather have more in Next. So I didn't liquidate my position in VG. It's just when it got to a $35 billion market cap, I'm like, okay, well, in terms of market cap, VG was a 3x, but I thought Next would have been potentially a 5, 6x. So I readjusted the portfolio. But now that you're back down to $9 again, you kind of get that opportunity to be closer to a 4.5x potentially for VG in the long term, plus buybacks, etc. And so with that, if you think about certainty, you're already producing revenue, and they have a different way of bringing on facilities comparatively than say Cheniere and Next Decade. So that alone, I think, is something that's interesting. So I've been buying Venture Global again. I was pausing, not like in a big way, but I was putting more money into Next over the past, say, 3-4 months until this drop. But now I think it's a no-brainer. If anybody that is kind of risk avoidant, VG is probably a better buy, but I think Next is still in the long term a great opportunity. But it has that risk associated with not having revenue, cost delays associated with LNG facilities, which are kind of famous for cost delays, as well as just startup delays. So that all has impacts on the IRR, the investment internal rate of return. And you keep in mind, even if it gets delayed, the interest rate doesn't stop, right? The interest payments on those things are still due, regardless of whether or not they start the facility. So, yeah.
I mean, one of the things about Next that's actually very interesting. I apologize for the noise in the background. I'm at a brewery, guys. I apologize. But one of the interesting things is that if you look at the investors who are in Next, who have invested in Next, one of them is Saudi Aramco, right? Like, they don't really place their bets in speculative companies. They've bought their energy ahead of time. They've bought their containers ahead of time as far as Next goes. And I have to be completely honest. Like, I don't want to say that I'm going risk off, but like when you see the market really running as hard as it's been for a while, this is the time for me to rotate some money into some value plays, because this isn't going to happen forever, guys. Like, the market is at new all-time highs today. I'm not like the most riskiest person out there. I think there's plenty of companies that could probably continue running. But that being said, like, I'm not an investor of OKLO, or I'm not an investor of EOS right now. Like, I might have left money on the table, but there's a lot of companies out there where, let's say the market falls like 5 or 10% from here, which I'm not going to say it's going to, but like, what if it does, right? Like, what if it does? It can happen. Like, it can easily fall 4% lower from here, which it just did 2 weeks ago. And how many people will really be surprised that happens? And then you go ahead and look at these other value companies and like, how much have they dropped? They have a much lower beta versus the S&P 500. So are they going to drop as significant as the S&P 500 goes, especially a lot of these growth stocks? Probably not. You got to kind of, I'm not saying like to sell everything. I'm just saying like, just be mindful, right? Like, not everything goes straight up. And when things go down, usually Verizon and all these low beta plays that aren't really as popular out there, that I know Steve is in a lot of, is going to be the ones that money rotates into as far as defensive adjustment. So I don't know. That's just the way that I see it. If I was in my early 20s, I wouldn't really give a shit.
Yeah, I think it's all how you're positioned. And look, that's one of the reasons why I'm really diversified and I don't take big gambles. Market go down 10 or 15%. You could have a lot of these companies get whacked 50%. I'm not really going to feel it, because I'm very diversified. I have a lot of ETFs and I have a bunch of different dividend plays. So, I mean, I can't predict what's going to happen. I think my premise is staying the same right now, that the large caps are going to get larger. And when I say large caps, I mean the mega caps. I just don't see a lot of companies that can compete with them. I think they're just going to get bigger. And I do think 2026, you could see exactly what Sam said, this be a market where you have a broad market rally in some degree. And companies like Coca-Cola, Procter & Gamble, and Verizon are going to surprise people. And I do think energy is going to catch a bid at some point. Not the smaller upstream producers, but when it comes to exploration and production, I got to tell you, I'm liking Chevron more and more and more, especially with the Hess acquisition. Like, that's not even in the numbers. So there's some stuff out there I'm getting very interested in.
Yeah, I mean, people forget that in 2022, and I'm not saying there's going to be a bear market, but in 2022, energy was the play. And I know a lot of people looking at like Enphase with a lot of the solar. I think that was a completely different scenario, because rates were very low at the time. And yes, they were going up, but the secular theme with people like diving into solar, trying to lock in at lower rate as far as their high debt that they'd have to take out in order to build a solar panel on top of their house. I think a lot of people were generally like diving into those companies and confusing that with the entire energy sector. But oil was like above $100 a barrel during that time, and a lot of these oil stocks were just rallying hard. Meanwhile, tech was just falling off a cliff. The market has like this Arcadian rhythm where it just goes up and down, right? But the people associate up and down with like the whole market, but that's usually with growth stocks, because growth stocks generally, like, what did we say? Like, it was like 67% of the entire market, right? So if Amazon, Apple, Google, and everything's going down, money rotates into utilities, it rotates into staples, it rotates partially into energy, but mostly like the defensive stuff. And that's why it means a lot to have like a balanced portfolio over time. So then that way you're kind of getting the best of both worlds, but then your tech or growth basket is growing exponentially higher to kind of make up for that, right? Because when the market goes down 10%, I don't know when, but when it does though, like if you're all in on all these growth companies, you're gonna get murdered, right? I think a lot of people felt the pain last Friday and the Friday before that and earlier this week. But how do you feel about that? I think that's something you kind of got to kind of gauge with yourself. Like, do you feel okay with that? Because there's people who are like, oh, 10%, 20% swings in my portfolio every day, that's fine. But then there's people like myself where it's like, I can't stomach that. So I need to kind of put my portfolio in a certain position where it's like, I'm okay with this type of volatility.
I think it comes down to what your risk tolerance level is and what you're okay with swings. I mean, you have some people that are just 100% in S&P 500 index fund. They're like, whatever happens, happens. And then you bring up a great point, Sam, because look, 2021 was a great year. And then 2022, forget Amazon and Alphabet being down 50%. And we had Apple holding up the market, and they were the last domino to fall. And they ended up taking a 40% haircut. Think about what happened with Palantir and Robinhood and SoFi. I mean, SoFi went under $5 at one point. So, there's a lot of people that are in a lot of chips in very concentrated names. And if you get a rotation or you get a recession, it could absolutely trigger something. And you have it when you allocate capital to companies, you have to understand the risk and what could happen. And that could absolutely happen. And the one thing I say is, for myself, don't do what I do, but I position myself where I have a lot of chips spread across a lot of different things. I don't put a lot of chips in just one or two things. So it helps me sleep at night. And I have a lot of different ETFs in there also. So it definitely helps me balance everything out. And if the market takes a 10% swing, I'm probably going to be right around there, maybe even do a little bit better, because some people won't like this, but I have some stuff in VEA, which is the International Vanguard Fund. I have stuff in SPEM, which is the Emerging Market Fund. I have the dividend funds like SCHD and VYM. So there is a method to the madness. I don't need to bat 1,000 on every single position. Like, there are things that I do for peace of mind.
Yeah, I think it goes back to, you kind of have to work on what works best for you, right? And where you are in your investment career, right? When I was first initially getting started out, I was more focused on security and trying to make sure that I had some sort of dividend income. And then, once the portfolio got large enough, I was like, you know what, like, I'm still super young. Like, why am I not trying to play a little bit more into the growth aspect of things? And that turned out very handsomely for me. And now that I'm kind of at that place, I always think about it. I'm like, well, maybe I should take some off the top and move it over to the safety pile again. And it's like, well, if I just put it in that, and then I could ride it up. And it's like, but at the same time, what do you want to do, right? And it's really up to your discretion. And sorry, I'm about to sneeze, and I hope I'm not trying to. But yeah, there's some people out there, like, they don't necessarily need to be focused on hyper growth. Like, maybe they sold a company for 20 million and they have a very simple lifestyle, and they just want to make sure that their money stays in safe hands. Maybe they shouldn't even look at equities at all. Maybe they should be more focused on CDs, or maybe they should be focused on corporate bonds or treasuries, where they could guarantee that their principal stays intact and they're getting 5% a year, rather than potentially focusing and risking the principal by trying to get 5% or more. So it really just depends on what people are doing and what they're trying to do. And I think oftentimes people are more so focused on trying to get into hyper growth, when really they just need to get their money right on a monthly basis. And I try, I say that tongue in cheek, kind of, but it's real. Like, I think sometimes people say, okay, I somehow figured out a way to get $1,000 in my bank account. I'm going to put this in the stock market and grow it to $1 million. When in reality, they need to figure out and have good money habits, right? Like, you expect your businesses to have, that you invest in, to have good money habits, but you yourself don't have good money habits. It's like very counterintuitive. And so I hope that people kind of think about it. It's like, well, I'm looking at the cash flow statement for this company and I want it to be good. Give me